Two shopping malls, same business model, built in the same era. But in 2026, their fates could not be more different. The first, in Providence, Rhode Island, nearly a quarter of the prime first-floor space, once reserved for the highest-end brands, now sits empty. Nordstrom left in 2019. Dozens of stores followed, one by one. Macy's, the last major name still holding on, has listed its own property for sale. The second, owned by Simon Property Group, America's largest mall operator, 96% occupancy. Tenant sales per square foot up nearly 14% in a single year. Mid-2026, their CEO put it bluntly, malls are having a cultural moment. Young people want to hang out here. Same industry, same leasing model, yet one is dying, the other is booming. So how do shopping malls actually make money? And why does the exact same formula produce two such opposite outcomes? Here's something few people know. When a store leases space in a mall, it usually isn't paying one flat monthly rent. It's paying up to 3 separate layers of cost, all at once, every single month. The first layer is base rent, the standard per square foot rent, just like any commercial lease. At Simon Property Group's top malls, this reached over $62 per square foot in mid-2026, up more than 6% in a single year. The second layer is percentage rent, a cut of revenue. This is a mechanism almost unique to retail real estate. If the store sells well, the mall owner also takes a percentage of that same sales figure, stacked on top of the base rent. In other words, the mall owner isn't just a landlord, they're a revenue-sharing partner with their own tenant. The third layer is CAM charges, common area maintenance fees, money for upkeep, security, cleaning, lighting, heating and cooling of hallways and shared spaces. This cost is allocated across every tenant based on square footage, regardless of how much any individual store actually sells. This is why a shopping mall isn't simply leasing space the way an office building is. It's simultaneously a landlord, a profit-sharing partner, and an operations service provider, all inside the same contract. Every traditional mall is built around a handful of anchor tenants, large stores, usually department stores like Macy's, JCPenney, Nordstrom, occupying enormous space at either end or in the corners of the property. Here's the strange thing about anchor tenants. They typically pay far less rent per square foot than the small stores lining the hallways in between, called inline tenants. Sometimes an anchor tenant even owns its own real estate outright instead of leasing it. So why do malls still cater to anchor tenants so heavily? Because their real role isn't direct revenue, it's foot traffic. Shoppers come for Macy's, then wander through dozens of smaller stores nearby. Anchor tenants generate the foot traffic that every other tenant in the mall depends on. And this is exactly the model's Achilles heel. When an anchor tenant leaves, a mall doesn't just lose one tenant, it loses the very reason people come to that part of the property. The small stores surrounding that anchor start seeing sales decline. Some close in turn, making the mall less appealing still, pulling even more stores out. Industry insiders call this phenomenon the death spiral. This is precisely what played out across many U.S. malls in 2025-2026. JCPenney kept closing stores in waves, some after 53 years of continuous operation, because parent company Catalyst Brands couldn't renegotiate lease terms. Macy's pushed forward its bold new chapter plan, closing roughly 150 stores. The original target of finishing by 2026 had to be pushed to 2028 because the scale of restructuring was too large. The result, according to 2026 Cushman & Wakefield data, the lowest-tier malls, Class C, carry a vacancy rate as high as 13.3%, more than double that of Class A properties. Same industry, but the gap between thriving and dying keeps widening. Just like the airline load factor we discussed in a previous video, occupancy rate is the mall industry's survival metric. But there's a key difference. Whether a plane flies full or half empty only matters for a few hours. An empty storefront in a mall can sit vacant for years, and every empty year still eats into maintenance costs, property taxes, and loan interest. That's exactly why top-tier malls don't chase 100% occupancy, which sounds counterintuitive. Simon Property Group CEO said it plainly in mid-2026, "We got back to where we are. I don't think we'd ever be at 100%. Why? Because keeping a selective amount of space vacant gives them leverage to negotiate higher rents with new tenants, rather than rushing to fill space with anyone at a discount. This is the single most important strategy in retail real estate in 2026. Rather than letting anchor space sit empty, major mall owners are pouring billions into redevelopment. Simon Property Group alone announced a development pipeline of more than $2 billion for 2026, with over $1 billion already under construction and another $1 billion that could break ground within the year. A concrete example, the former vacant Neiman Marcus space at Copley Place in Boston is being converted into a new luxury retail hub with high-end international restaurants. This isn't simply filling a gap, it's upgrading the space's value into an entirely different tier. And here's a striking financial detail. When Saks off Fifth went bankrupt and returned roughly 1 million square feet of space to Simon in 2026, the company had already re-leased about half of that footprint, with projected rent rising from $18 million to as much as $44 million a year, a 67% increase. Here's the next strange thing about this industry.
Sometimes a tenant's bankruptcy is precisely the opportunity for a mall owner to re-rate the value of the asset, as long as the location is strong enough to attract a new tenant willing to pay more. Not every risk comes from inside the property. There's a phenomenon called cannibalization, when two malls sit too close together and compete for the same limited pool of shoppers. Industry observers sum up these cases with a grim equation: one healthy mall plus one newly open mall equals 0 truly successful malls. This is why location, not scale or design, is the single biggest determinant of a mall's long-term survival. A mall holding a dominant position in its trade area can raise rent steadily for decades. A mall forced to split its customer base with a nearby competitor can spiral into decline after just one bad economic cycle.
Most major U.S. malls aren't held by a single private owner. They're held by REITs, real estate investment trusts, like Simon Property Group or Macerich. REITs have one key legal feature. They're required to distribute at least 90% of taxable income to shareholders as dividends, and in exchange, they're exempt from corporate income tax at the company level. The metric investors watch most closely isn't standard net income, it's FFO, funds from operations, because real estate carries enormous accounting depreciation that distorts net income relative to actual cash flow. In Q2 2026, Simon Property Group posted FFO of $1.25 billion, up 7.9% year-over-year, even after losing nearly 1 million square feet to the Saks Fifth bankruptcy. This reveals an interesting paradox. A mall REIT can still post strong cash flow growth even while riding out a wave of tenant bankruptcies, as long as it can release that space at a higher rate. This is exactly the advantage Class A properties hold. They turn tenant bankruptcy risk into an opportunity to reprice the asset. Lower-tier malls, by contrast, don't have that negotiating leverage. When a tenant leaves, they struggle to find a replacement willing to pay a comparable rate. Cash flow declines, debt servicing capacity weakens, and reinvesting to upgrade the space becomes impossible for lack of capital. Here's the biggest secret behind why some malls aren't just surviving but growing in the e-commerce era. They've stopped competing with Amazon on merchandise and started competing on the one thing Amazon can never sell: in-person experience. The tenant makes it top-tier malls is shifting sharply away from pure retail towards upscale restaurants, movie theaters, gyms, spas, and, as in some of Simon's projects, even apartments and hotels built right into the property. Converting old anchor space into mixed-use complexes doesn't just fill a vacancy, it creates an entirely new reason for people to keep coming back, services that can never be click to buy online. Second strategy, turning a former tenant's bankruptcy into leverage for repricing. We saw this earlier. An $18 million Saks Fifth space can be released for $44 million. Financially strong malls treat a wave of retail bankruptcies not as a crisis, but as an opportunity to reset rents to current market levels, which are usually far higher than decades-old legacy leases. Third strategy, being selective about tenants rather than filling space at any cost. Q2 2026 data shows Simon Property Group had already completed more than 87% of its 2026 lease expirations, a very high rate, while still pushing new lease base rents up 17% year-over-year and cutting tenant allowances by 12%. That combination is unusually landlord favorable and rarely happens all at once in commercial real estate. Fourth strategy, and this is the answer to the paradox from the opening of the video, location and asset quality decide everything. Facing the same nationwide wave of anchor closures, Class A malls in prime locations, like Simon Property Groups, turn every closure into an upgrade opportunity. Meanwhile, lower-tier malls in weaker locations, like the Providence Place Mall we opened with, lack the pull to attract replacement tenants and fall straight into the death spiral described earlier.
Back to the two malls from the opening. Providence Place and Simon Property Group's malls aren't failing or succeeding because malls are dying or malls are making a comeback. Both stories are true at the same time. They just sit at opposite ends of the same industry. A mall doesn't make money simply by leasing out space. It makes money by managing an interdependent ecosystem. Anchor tenants pull in shoppers, small tenants pay higher rent because of that traffic, and percentage rent turns the mall owner into a partner who shares both the risk and the upside with their own tenants. When that loop stays intact, a mall is one of the rare, remarkably stable money machines in real estate. When one link in that chain breaks, even just one anchor tenant walking away, the entire ecosystem can collapse with it. Which category does the mall near you fall into? Reviving with new anchors and premium experiences, or showing signs of a death spiral? Tell me in the comments. And if you're curious why malls written off as dying just 5 years ago are now being revalued as multi-billion-dollar assets, the next video digs into the exact mixed-use redevelopment wave reshaping the entire U.S. retail real estate industry.